If you buy a house, you pay the mortgage as soon as it's yours and you move in. But what do you pay when you're building? Do you actually need to pay the whole mortgage? And what if it takes years to build? I'm very lucky to have my dad, Nicola Kefalianos, who's built over 100 homes and created thousands of loans as a mortgage broker. He's going to open up everything about mortgage repayments and building. Things like, what's the difference between a normal mortgage and a building loan? Does it work out more expensive to build than buying an established home? What if I buy land and then I build? Or what if my build gets delayed? All that and so much more.
That's right, Nicola. I'm going to walk you through all the differences between a construction loan, house land package and buying established. It might actually surprise you. The one that looks more expensive to begin with is potentially going to be cheaper for you. So why don't you start asking me questions and I will give you the answers that you need.
So first, I think we should cover what the difference is between a normal mortgage and a building loan.
Yeah, sure, Nicola. So when you're buying an established house and let's say you're borrowing, call it 90% of that purchase price, the mortgage repayments will start off being principal and interest right from the start. So you're basically setting up those repayments to be paid down over a 30-year period. So that's buying an established house. When you're building though, what happens is the bank will lend you the money as you need it for a construction loan. For example, you buy the land, you put your deposit down, they'll give you that difference that you need for that land purchase. As the build goes on, what happens? Let's just say there's 5 stages in a build.
Well, what are the stages, Dad?
So the stages of the build are generally footings get laid, frames go up, walls go up, roof goes on, your second fix, which is your cabinetry, and then the final completion of the build. They're the general stages of a build.
Do they all cost the same amount or they're going to be different?
They're generally all slightly different. So for example, the footing might be 20%, you then might have the frames at 15%, you might have the roof at 10%. Mm-hmm. So it is all different, but it all comes back to that full contract price and it works out to be the full build at 100%. So it's broken down normally into around 6 stages with most builders. Some builders even break it down even further, but it's normally about 6 stages. So what happens, a builder will complete the footings, they'll send you an invoice. They'll complete the frames, they'll send you an invoice.
And do you have to pay that straight away?
The bank will pay that straight away, yes. So what happens, you send a progress claim into the bank.
Yeah.
And the bank will pay that from your loan.
On your behalf.
From the loan that's been approved.
And then you'll make the repayments.
So the way that works, let's just say the footings get laid and let's just say the footings costs $70,000. So your loan will increase by $70,000. You then pay the interest only on that portion of the loan you've drawn. Okay. So let's just work on some numbers. Let's say a $350 purchase on the land. Mm-hmm. You're borrowing $300,000 for the land purchase. So your loan is already $300,000. So you're paying interest on $300,000 to start off with. You then lay the slab, your loan increases to $370,000 because the first claim is $70,000.
So then you're paying the interest upon that.
You're paying interest on $370,000. Stage 2, let's just say it's $50,000. The builder sends you an invoice for $50,000. You send that to the bank. You authorise the payment. The bank will pay the builder directly $50,000. So your loan increases from $370,000 to $420,000. Mm-hmm. So you're now then paying interest on $420,000.
Okay.
So as the progress claims come through, your loan increases.
And you're just continue to pay
your
the
repayments
interest.
Your interest cost per month will increase during that build. So, and then what happens when you finish your build, your loan then switches to principal and interest on completion, which is when you then start paying that loan down. Does that make sense?
Yes. Approximately how much interest would you be paying during a build?
So let's just say you're buying land $350 and building for $350 and you're putting a $50,000 deposit down. Roughly, approximately over a 12-month period, your interest cost is around $30,000. That might start off at say $350 a week, $450 a week,
and it increases
and it increases at each stage, and it ends up being say $700 a week towards the end, and then it will switch to principal interest.
And principal interest is where
once the house is complete, then you start paying that loan down like a normal home, like an established home loan as well.
That sounds like a lot of money to pay when I can't even live in it yet.
It does sound like a lot of money, but let's break it down to the difference between buying an established house and buying land and building. So when you're buying an established house, let's use the same figure of $700,000, so $350 and $350 for land and build, as opposed to $700,000 established house. If you're buying an established house for $700,000, your stamp duty is going to be around that $35,000 to $40,000 that you're going to have to pay extra.
Whereas for an established house.
For an established house. On top of that, you're not going to get the first homeowner's grant of $15,000.
Because it's already established.
It's established. So that's $40,000 plus $15,000, which is $55,000 extra that you're going to have to pay if you buy an established house. As opposed to you're buying land and building, your interest cost is $30,000. In South Australia, for example, you're going to get $15,000 first homeowners grant.
And no stamp duty.
And there's no stamp duty. So you're down, your costs out of your pocket then is only $15,000. So that's $15,000 as opposed to $55,000 for an established house. So you can see where there's big benefits in buying land and building.
Yeah.
And also getting into a property with less deposit.
So essentially it's a cheaper option.
So it is a cheaper option, but it doesn't look like it at first. So although you're paying that interest whilst you're building, you would be saving that money because you're not paying stamp duty, and you're also getting the first homeowners grant, which you wouldn't get if you were to buy an established house. The other thing to take into consideration when you are building is you might still be living at home with your parents, so your overheads are quite low. So whilst you're building, you can still afford to make those repayments whilst you're building. Or if you are renting or renting with some friends, try to keep your overhead, your living expenses quite low whilst you're building, or you can have a buffer put aside to help cover some of those interest costs whilst you're building as well.
So what would be the options for getting into a new property?
Yeah, so there's several ways you can do this. You can either just buy land initially and then find a builder to build you a house. You can buy house and land packages, which is buying something that's advertised with a builder where they've got land available and they've packaged it up with a price as well. So it's house land package. Something else which you may consider is buying off the plan as well. So you can still get into a new property and not actually go through the build process yourself. So I'll go through that quickly because that's very different to what we just talked about going through the build process yourself. So for example, you might buy an apartment off the plan, which means you pay a deposit down, put your deposit down, you don't have to settle until it's completed. For example, I know at the moment there's apartments available for sale at, say, Tonsley. They might be $900,000 for an apartment there. You pay a deposit, but you don't settle until it's finished. You still get the benefit of not paying any stamp duty because it's a new property. You still get the benefit of the first homeowners grant of $15,000 because you're a first home buyer, but you're not having to pay the interest during the construction stage.
You just pay upon settlement.
You settle it on completion, and then you start paying the loan principal and interest. So that's another way of doing it as well. The disadvantage of doing it that way, though, is you generally don't have many options available in changing anything on your plan. So you can't change your floor plan at all. You can't change your selections.
Okay.
They might give you two colour schemes to choose from, and that's basically it. So that's the disadvantage of buying something off the plan as opposed to going through the process of building it yourself. So when you're buying land, there's several ways you can do that. So you can buy land in an established neighbourhood where someone might have bought a block of land, subdivided it, and selling the blocks of land off. In that situation, you normally have to settle in the land, find a builder and organise a building contract, which might take you 6 months to 9 months, and then start building. So the lead time from buying the land and building, you're then having to service that land loan and paying interest in that land loan until the builder's ready to start building. So that's buying land in an established suburb where you're just buying the land by itself.
But if I had a builder in place earlier on, would I still have to pay the interest?
So if you're buying established land in a neighbourhood, there's normally quite a large gap between the time you're settling and starting to build, because you've then got to do your plans, get council approval, do your selections, and then the builder will do your building contract and then start building. So there's quite a large gap from you buying the land to starting to build, which means you've got to be paying interest in that time period.
So you're essentially paying more?
Correct. So that's buying land in an established neighbourhood. Buying land in a new land division is different again. So what happens there normally is when you're buying land in a new subdivision, the developer normally gives you about 6 months to 12 months sometimes by the time you sign the contract to settle on that land. What that means in that time frame, you can then start speaking to builders, doing your plans, getting everything in place so that when you do settle on that land, the builder can start straight away.
And during that time, you're not paying.
And during that time, you're not paying any interest on the land because you haven't settled yet. So you basically settle on the land and start building straight away. So that's the ideal scenario, to have no gap, so you're not paying interest on a block of land for no reason, just sitting there.
Yeah.
So in a new land division, there are benefits there because you can line it up to settle and start building at the same time. The other benefit of a new land division as well is capital growth is often quite strong because especially if you get into a land division in the early stages, because what they're selling land for, say, today in a new land division would be a lot lower to what that land will be worth once there's all houses built in that suburb and that suburb is established.
Yeah.
So buying land at the beginning in a new land division, there are definitely benefits there for capital growth.
So the final option, house and land packages. Can you explain the finance side of that?
Yep, sure. Very similar to buying land in a new land division where you have time between signing a contract and settling on the land. With a house and land package, generally the work's all been done for you, where the builder has packaged that land up with a build of what they can fit on that block. So they might have a plan, and if that plan suits you, you're buying the land with a
plan.
design, and then you pretty much go straight into the build without having to settle on the land first and wait 6 months, 9 months paying interest.
So you're just paying on both.
So you're paying on both. So so if it's a house land package, you're settling straight away on the land, and the builders should theoretically start straight away.
So you're guaranteed the plan for the house. Selections, you just have to simply make them.
You can still make your changes in the selections generally,
and then
probably some minor changes in the plan, but not major changes in the plan.
But you're essentially not paying a massive gap between the
Correct.
purchasing of the land and the building.
Yep, and you have to make sure you're happy with that builder as well. So the difference between buying land and building and buying a house land package is
you're already given
you've got options of which builder you can go to, as opposed to with a house land package, you're limited to just working with that one builder.
So my final question to you would be, what if my build gets delayed?
Yeah, good question, Nicola, because that can happen, and that's where it's very important to choose the right builder and understand they are an established builder, they've got good runs on the board, and some builders actually lock a time frame in too for the build, which is quite important too.
Mm-hmm.
So, but if the build does get delayed for some reason, which 2-3 years ago that was very common, the builders were struggling because of COVID and getting supply of product. That issue has now been resolved, and things have slowed down again, and builders are back on track into building within 9 to 12 months for a new house.
Okay.
But if your build does get delayed for some reason, you're there left holding that mortgage, paying interest
until the
build is finished. So let's just say they've halfway through your build,
okay,
and there's some delays for some reason. You're then having to pay that interest of whatever loan you've drawn out until the builder finishes. So there's nothing you can do apart from just keep paying that interest.
So there's no possible way of like pausing the loan or whatever.
No. So that's where it's important to, first of all, choose the right builder, but then also have a bit of a buffer behind you. So understand that you can afford to make those repayments whilst the builder's on hold, worst case scenario. So whether you have a buffer saved up or whether you're living with your parents and got a good income behind you still to make those repayments, make sure you've got a plan in place as to what will happen if the builder does get delayed.
Okay.
Just in case.
All right, Dad, there was a lot more to this than I thought. By the sounds of things, it looks more expensive at first to build a new home than buy established. But when you broke down the repayments and the grants you get, it actually looks like it's cheaper. But then it's really important to take into account the difference between buying land and building, house and land package, or off the plan, because they've all got slightly different repayments. So another thing I learnt was that you can have a small deposit when you're building a house because of all the grants. And if you want to learn more about homeowners grants, rewind back a few episodes. We've got an episode of how they differ from states to state. Thanks so much for this one, Dad.
Thank you, Nicola. I hope you learned a lot.
Hope you guys have enjoyed this. My name's Nicola Kefalianos, and we'll see you on the next episode.